US Federal Reserve raised its benchmark interest rates by 25 basis points. The central bank appears reluctant to signal that its aggressive campaign to beat back price increase is nearing an end, even as it begins to balance the benefits of the initiative with growing recession risk. Now, to decode the Fed's move and its possible ramifications on markets across the world and in India, we have on board Mahendra Jajoo, CIO, Fixed Income Mirae Asset Management. Mahendra, good evening and welcome to the show. So let's talk about the Fed's move. Now, a minimum height was obviously on expected lines, but then what's important is to read the comment, which also means or which also says that it is not going to be a time yet for them to start cutting back the interest rate. There could be a pause after a few more hikes that you will tell us after your analysis, but definitely a rate hike which all the pundits were predicting is still far away.
Yeah, I think if you look at the Fed commentary, they have clearly indicated about the possibility of further rate hikes, and the Fed is not acknowledging the possibility of any quick, stop to rate hikes, or they are not willing to engage into any discussion about when the rate cuts may start, and which is pretty much on the expected line, because even though the inflation in the US has begun to come down, they still say that the inflation is higher than the target, and they want to keep the real rates positive for a while so that the inflationary concerns are addressed on a structural basis. Now, there is a little bit of disconnect between the market and the Fed because market is watching the inflation numbers coming down, and market is also factoring in the fact that the factors which were contributing to inflation have also begun to help. For example, the natural gas prices, which had gone to high of $9 plus, are now at about $2.50. Just about a month, 6 weeks back, the natural gas prices were at about $5 plus. So they have corrected by more than 50% in just the last 6 weeks. The oil prices continue to soften. On the other hand, there is a little bit of concern on a revival in the inflationary trend if China opens up with the vengeance. And we have already seen the Chinese PMI number this month cross 50 threshold again, which means that the China economy is again in the expansionary mood. So while the market is projecting the current trend and expecting the inflation to continue to come down, and also market is focusing on the softening economic indicators on the growth side, the Fed is still focused on the inflation, which still remains higher than the target. So I think at this point, like in the last year when Fed was saying that the rate hikes will be slow and they were welcoming inflation, it will be more appropriate to look at the emerging trend, and therefore I think it's a fair conclusion that Fed will go into a pause mode. Maybe in the next meeting, I'm quite aware that Chairman Powell said that the Fed will continue to hike rates, but I think the market is building expectation that the Fed may pause in the next meeting in March or at best in May, and I think that's a real possibility the way the data is coming in.
This pause mean for the Indian market, Mahendra, because now the Fed outcome is out. We are done with the budget. RBI has also maintained its stance that they are doing whatever possible to control inflation, and also the focus is now on growth. But this pause coming, what it means for Indian market and inflation in India?
So inflation in India is primarily driven by the global factors. And we had seen that in the months of April and March, when the oil prices had gone well above $100 and so on, our inflation also had hit a high of 7.5% plus. But now our inflation is already down to 5.7%. RBI is projecting the inflation to fall further to close to 5% in the next couple of months. RBI has already hiked the rates to close to 6.25%. We have the RBI monetary policy review meeting next week, where we are expecting another 25 basis points rate hike, with which the repo rate goes to 6.5%. The global central banks are now moving closer to a pause status. And our real rates, if you assume that inflation is at 5.7, are already in the positive territory. So with that, India is amongst very few countries like Brazil and Mexico where the real rates are positive. And therefore, uh, from the perspective of India, where the growth momentum is showing a bit of a slowdown trend, it is appropriate in our view that going forward, after the rate hike that may be possible on 8th February, RBI will go in a pause mode. Now, that means that the rate hike uh, momentum is then over. But at the same time, for the rates to come down, you need far more favorable factors. So we have just seen that while the government has maintained the fiscal deficit at a reasonable level of 5.9% in the budget announced yesterday, and the overall borrowing program is something which the market can absorb quite comfortably, but it still doesn't give us room for the rates to come down in a very significant way, at least in a quick time. So we are still having core inflation, which is above 6%. The inflation headline basis is below the 6%, the upper band of the RBI's tolerance limit, but still on the higher side. So our sense is that while the long-term rates might have peaked in the current cycle, and RBI may move to a status quo mode after the policy next week, the interest rates will remain range bound. And our best hope is that they don't go up from here, but any meaningful easing in the interest rates in a quick time is, I think, something which will have to wait for far more favorable developments to take place.
So, talking about Jerome Powell's statement itself, a lot of it will be data driven, but specific focus was also on the jobs data. It looks like a lot of decision depends on the outcome of the job data. Can you please explain us the significance of that and how is it linked with the hiking of interest rates for the Fed?
So the Fed has twin objective to maintain the maximum potential employment and to control inflation. Now, obviously, the conventional wisdom is that if the employment situation is very tight, which means that the job market is very tight and there are too many job openings and there are not too many people available for those jobs, then it tends to higher wages, and then that in turn leads to higher demand and therefore inflation. So low unemployment rate is generally associated with a possibility of a higher inflation in the coming months. But Fed clearly said yesterday that if the employment situation remains healthy and at the same time if the inflation can come down, then that is the best situation they can have. Now, at the moment, the employment situation in US still seems to be very healthy. The unemployment rate is still around 3.5 to 3.7%. We have heard a lot of news about the firing in the tech sector. A lot of the big tech companies have fired a number of people, but then in proportion to the total size of the US, tech companies are not very significant. So overall job momentum is strong. But more important is that the inflationary trend is beginning to subside. The incoming data, to the extent we have now, clearly suggests that inflation should continue to come down. Therefore, I think the Fed would have been extremely worried if the unemployment rate is low, but the inflation is continuing to harden. But we now have a situation where even though the employment rate is very healthy, the inflation is coming down. So I think the Fed will not be too hassled or worried about the unemployment rate as long as the inflation continues to ease. So let's say if by March, the headline inflation in US comes close to 4.5%, then I think Fed will be happy that the employment situation is good and the inflation has also come down.
But do you think the way things are unfolding in the US is very optimistic, at least as compared to what was expected?
So that is a good news. As I said, I mean, the people were drawing three scenarios: deep recession, shallow recession, and then continued heating up of the economy. I think right now we are getting into a zone which is a very welcome development, that we have a very, you know, weak momentum in growth. So the growth is still not negative. The last year, the GDP in the US grew by about 1% on an average last quarter, and the inflation has begun to ease. So if we have a situation of the soft landing of the economy, which means a very moderate growth or a very shallow recession, coupled with easing inflationary trend, I think that's the best situation we can have. And as you said, that the incoming news and the incoming data is indicating a very healthy situation for US. And since the US economy is integrated with all other emerging market economies, it's good news for everyone. We have seen the US dollar index fall from a lofty level of 115 to now around 101. That has taken a lot of pressure off the emerging markets because their currencies have also begun to stabilize. The FPI flows have stabilized in most of the emerging markets. So it's a win-win situation for everyone. And one should therefore maybe compliment the Fed for achieving this situation, which looked nearly impossible 6 months back. So I think Fed would be happy with what it has achieved.
The budget, Mahendra, what all do you draw when it comes to controlling inflation and giving a push to growth in India?
I think right now in India, we have a very healthy situation where the inflation has begun to come down, and just not important enough that the headline inflation has begun to come down. The factors which were contributing to inflation has also begun to indicate that inflation should continue to remain lower. So we have a healthy crop coming in. The rural economy is doing well as per the most of the earnings call that the top managements have given. I think every single management has indicated a revival or at least a good momentum in the rural economy. The oil prices have come down. The oil prices have consistently remained around 85-90 band for almost a quarter now, in spite of all the negative news. There was a lot of concern about the energy crisis in Europe in the beginning of 2023. We have seen a very healthy situation. The fact is that the natural gas prices are now at the lowest of last 1 year, and the commodity prices in general are pretty stable, although we are seeing some pickup in the last couple of weeks because of the news of the Chinese economy opening. But the Chinese economy opening is again going to help revival of the economic growth. If you have noticed that for the first time in over 2 years, the IMF has upgraded its global growth forecast last week. So that's a very healthy welcome. So I think as far as India is concerned, we had an excellent budget yesterday. I think this is the one budget where almost universally everyone has applauded. Even the opposition parties have also not had much criticism about the budget. Even though this is a budget just before the election year, there wasn't enough hint of any, overdrawn populism in this. The focus is on capex infrastructure development. We have almost 10 lakh crores of capital expenditure from the central government itself. Over and above that, there is another 3 lakh crores of allocation to the states for the infrastructure projects. So I think if we have this situation, then we are pretty much looking at a scenario where the growth is around 6% to 7% band, and the inflation is somewhere in the 5.5 kind of a range, so between 5 to 6%. That gives the Reserve Bank the elbow room to not worry too much about inflation, and therefore be a little bit relaxed and support growth more vigorously. But if the inflation remains at around 5.5, then it doesn't give the Reserve Bank enough of a room to go aggressively on growth supporting. So we are looking at a kind of a stable environment where growth can continue at a moderate pace without too much concern on the inflation. So sometimes people call it the Goldilocks scenario. Possibly we are heading for good times with no concern on either extremes.
All right. So optimistic view and a step towards a brighter future as far as the budget is concerned. Thank you so much, Mahendra, for being on the show and explaining all the detailed points to our viewers. But then on that note, let's take a quick break, and post that we'll be talking to our viewers and taking their financial planning questions.
Co-presented by SBI Life, अपने लिए अपनों के लिए. Knowledge Part